And welcome back. Bruce Porter joins us now for this week's Dollars and Cents segment. Good to see you again.
Good to be here.
Okay, you gave me a piece of paper here, and I kind of know what we're going to be talking about anyway. We're going to talk about contributions, IRA contributions, to be exact.
Yeah, you know it's tax time.
Yes,
so
yes, it
the
is.
phone's ringing off the wall. How much can I put in my IRA? Things like that. So we're going to hit some highlights today. We're not going to discuss all this tax stuff.
Right.
But IRAs, if you're under age 50, the maximum contribution is about $6,000. That's the most you can do.
Right.
You can do any denomination under that too. All
Well,
right.
that makes sense, yeah.
Now, if you're older than 50, you can put up to $7,000 in. So that's a good thing.
Uh-huh.
You're older, you're allowed to put a little bit more money away.
Okay, 6 up to 50.
6 up to 50, and then over age 50,
Yeah.
7,000 is what you can put in.
Okay.
And that's good. So you're still working, you're still putting money in. That's great.
Okay.
Right?
Now, standard deduction.
All right.
Talk about that.
And that's important because under current tax rules, we're getting a really big help on this regards. So standard deduction, if you're single and you're older than 65, you can take $14,250. So that means your itemized deductions would have to be more than that to go that route. You'd be better to just take a standard deduction.
It's a huge time saver.
Oh, it's a huge time saver, and it's just set in stone. $14,250 of the first taxable income you have is tax-free. That's kind of how that works.
That's kind of a nice thing to know.
That's a
Keep
way
it in
to
mind,
think about it.
Because you can get a pretty good ballpark guesstimate of what your deductions are going to be.
Right.
You kind of know from year to year.
That's right.
Unless something crops up big time.
If you're married, filing jointly, and you're under age 65, you get $25,100 in a standard deduction. If you're older than 65, you get an additional $1,350, takes you all the way up to $26,450 is what you can take off. And unless you've got itemized deductions above that, that's your best route when you do that. So always get a good tax person to help you.
Those are the target numbers.
But these are the target numbers. Now,
Okay.
if you're self-employed and you're a small business owner and you're putting money in a SEP IRA,
Right.
which is a simplified employee pension, you can put up to 25% of your compensation up to $58,000. So, some people want to put more away than $7,000 a year.
Sure.
And they're self-employed or whatever, they're a business owner. That's one way you can put a large amount of money away in a qualified account. Now, if you got a different type of plan through a small business called a simple,
Right.
It's a elective deferral plan, a simple IRA, up to $13,500 if you're under age 50, $16,500 if you're older than 50.
Okay, talk to me about deductions versus credits.
Good question. So it always comes up. What's better, a deduction or a credit? Well, it depends on what you're doing, right?
Yeah,
a deduction
usually does.
reduces your taxable income and allows you to get a credit for the bracket you're in. So if you're putting $1,000 in an IRA and you're in a 12% tax bracket, you're going to get a $120 tax credit.
Okay.
12% of that.
12%.
Now, so in the same breath, though, what if you've got a chance to buy a $1,000 tax credit? What's better, a deduction or a credit? It really depends, because a credit comes right off the amount of tax you owe, dollar for dollar. So $1,000 in a tax credit is $1,000 less taxes that you owe. Does that make sense?
Important to know the difference.
Well, it is important, because do you want to pay less tax, or do you want to put more in your pocket by having a credit, taking that dollar for dollar deduction?
I think this time of year more people go, yeah, I'd like to pay less tax.
Yeah.
Yeah.
So you could look at it either way.
Okay, now we do have a question from our viewers.
Yeah.
Here we go. Now, can I convert my required minimum distribution, the RMD, to a Roth IRA and satisfy the RMD requirement in the same tax year?
That's really a good question because it comes up all the time.
Yeah.
If I'm forced to take money out of my IRA,
Yeah, can I put it in?
can I just go ahead and convert that to my Roth?
Sure.
Well, and the answer is no, and here's why.
Oh,
Well,
Okay.
when you are forced to take a distribution,
yeah.
they're forcing you to reduce your IRA, to take that money out. A Roth conversion of your IRA is a rollover to a different type of IRA. Now, if it's not a bad thing to convert portions of IRA money to Roth, as you can absorb the tax liability, because what you're doing is you're freeing up money and accumulated growth down the road, tax-free forever for everybody. For you, for your heirs.
Well, you've paid the taxes. As soon as you withdraw, you pay
So
the
now
taxes.
that Roth IRA is going to grow, and the growth is tax-free, the principal is tax-free. It's all a good thing going forward. Now, what's better, have 200 grand in an IRA or 200 grand in a Roth?
I think it depends on where you are in life, doesn't it?
It does. So if you got 200 grand in an IRA, everything you pull out of that IRA is taxable.
In the Roth, it's not.
In the Roth, it's
You've already
not.
paid the taxes.
So always look for a good tax person to help you out.
That's right. If you have a financial question for Bruce, visit his website, resourcecenterinc.com, or give him a call at 417-882-1800. Bruce, thank you so much.
See you next week.
All right.